The Redbox stock has been definitely a popular stock to talk about, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Redbox has had an amazing run recently, as the market participants believe that there can be a huge amount of stocks to be squeezed out of the short positions, and this marked the beginning of a self-fulfilling prophecy, whereby the stock was pushed higher because people believed that it would have to increase with the short redemptions, and that the collective behavior caused the stock to increase, arguably reducing some of the short positions in the process. Now, nevertheless, things are no longer where they were a few weeks ago, and by that I'm saying like purely on a stock price perspective, because the price retraced back significantly, and it's worth wondering if now is a good opportunity to enter the trade or to stand on the side because the party might be over. For one part, I believe that the stock still has a significant amount of shorting interest, not just because the company has a weak business model, but also because shorting from a high price point can be very lucrative. This is how those short operations make their profits. Another aspect to keep in mind is that Redbox may not have a very stellar business model to attract long-term investors, so it would be more appropriate to consider the title as a speculative trade in the portfolio instead of being a long-term holding. Now, let's also take a look at the technicals of Redbox. The trading volume of Redbox has recently just been 2.1 million shares versus the average volume of 17 million shares. Over the previous 52-week period, the price fluctuated between $1.61 and $27.22. The trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activity and momentum for whatever the trend the stock is going through at the moment. It often gives you a first idea about the popularity of a stock. When we use it to compare against the average volume, it can also tell us if the company is enjoying additional momentum to reverse the trend or to break through the current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal could happen soon. The market cap of Redbox is currently at $282 million versus an enterprise value of $297 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of those growth companies is the intangibles. Of course, Redbox is no longer a growth company, but it's still worth reminding people in general. So, intangibles are not items like equipments or inventory. They're more guarantees that this company can grow significantly in the future. Okay, I mean, maybe not guarantees, but like pledges that a company can grow significantly in the future, such as schematics, intellectual properties, or brands. And for startups, most of their valuations are based on the intangibles, which might have been appraised or valued in very favorable market conditions. And in concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, giving a false impression to market participants that a company is trading at a discount. It's actually just trading below the book value, but that doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place and only deflating back to a normal place ever since. As we compare to the current price, the historical price fluctuations, the stock is 21% higher than the 1-month low, 236% higher than the 12-week low, and 286% higher than the 52-week low. On the options market, which gives a hint about the market sentiment, the implied volatility is 220% versus a historical volatility of 240%. The put-call volume ratio is currently 0.11. It is normal for many stocks to tend to have a higher put option than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 1.2 thousand contracts a day versus the 30-day average of 60,000. In terms of open interest, the most recent volume of open interest has been 104,000 contracts versus the 30-day average of 223,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you premiums with an obligation to execute those rights if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there could be a possible uptrend on move, or that a reversal could happen on this uptrend if there's a lot of call options. The reasoning behind the theory is that most traders, especially retail ones, tend to catch the train once it's gone, and most of those options would expire worthless. In terms of its shareholder structure, institutional shareholders own 291% of the outstanding shares. The biggest shareholders include Apollo Management Holdings, Vanguard, and Millennium Management. It is relevant to understand the shareholder composition of a company because this helps to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it could be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is between 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. This is obviously subject to a lot of exceptions, as many great titles could also be held by retail investors, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there is significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, like what happened with GameStop and AMC. Current short interest is 154% of the total float, and 54% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, with a significant portion of the short volume coming out of the dark pools, this may suggest that there are institutional positions taken to short the stock, and there would be potentials for a short squeeze. My recommendation for now is to stand on the side and wait for the stock price to retrace back further, almost back to where the stock was before the takeoff. And by then, I think that it would be worth the risk taking if you decide to buy the Redbox shares as a side position, expecting that the stock would short squeeze once again in the future. If that's the case, I would recommend to commit between 1 to 3% of your portfolio in the stock, and I would also recommend to split the allocation in batches of 20% at a time, so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, If your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions, as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.